The stock market crash of 2025 is now here. Take a look at the NASDAQ, triple Q right here. Follow this trend line up. We have a lot of support bouncing off this 2023 low going all the way up. Maybe we go down a little bit more, maybe we don't. But one thing that I do know is the market's going down. Look at the S&P 500. Look at this trend line coming up. Again, blowing off this top right here. It's likely that we're going to retrace down to the support line right here, somewhere around like 580 for the S&P, which would indicate roughly 5 to 10% more of a decline. On top of this, everybody is worried about a stock market crash. Everybody is worried about an AI bubble. Everybody is worried about stock market valuations. Everyone's saying AI is a bubble. What are we going to do with all this stuff? Let's break it all down in a very simple way to understand. And I just want to start off with this. I couldn't have been more clear in the last couple weeks, the last couple months, that this stock market is overheated. Valuations are stretched. It is obvious. It is clear. Go watch my other videos. You should not be surprised right now that the stock market is going down a little bit. You should not be surprised that we are seeing red in our portfolios right now because stocks are just simply outrunning the fundamentals. So take a look at this chart right here. It's pretty obvious that the market is still overvalued even with the dip that we got so far. The lighter line that I'm tracing right now, that is the S&P 500. The darker line is the earnings per share growth. In the long term, the stock market's going to follow what the earnings per share actually does. In the short term, though, like 1, 2, maybe 3 year basis, the stock market doesn't always have to make sense, but eventually it will make sense, and eventually we will have reversion to the mean. So whether earnings per share goes up or the market comes down or a combination of both, these two lines right here are going to overlap again. And let's just say that they do happen to overlap. Like, how far can this market actually go down? Well, if we go down on my cursor down to where the earnings per share is actually at, you go to the left, you could see that we're at a $5,600 S&P 500, which would indicate roughly a 15% stock market correction from the levels that we're at right now. And if we go back and look at the charts, you could see that the market's already down quite a bit off of the all-time highs. We'll go over to the S&P 500, which is VOO. Let's flip it to a 1-month chart and just see how low we actually are. From peak to trough in 1 month, the S&P is down roughly 4%. So really not that much. Like, the stock market could correct 20, 30, even 40%. We've only seen a 4% stock market correction from peak to trough. If we take a look at the NASDAQ from peak to trough, how low did we go so far? Coming from the top right here, all the way down to the bottom, 6.58%. A little bit more meaningful of a dip on the NASDAQ, but hey, the NASDAQ is more fundamentally overvalued, so it is justified for that to go down a little bit more. And if we just take a look at the holdings within the NASDAQ, you could see that it's definitely heavily skewed to the upside. We have companies like Nvidia, Apple, Microsoft, Broadcom, Amazon, Google, Tesla, Meta, Netflix. Like, a lot of these companies on this list right here, they are a little bit expensive. I mean, they compose 53% of the index. Just the top 10 companies are 53%. So again, I'm trying to get in your guys' head. The market ran up a lot. A lot of these companies right here are overvalued. A lot of them are overhyped. A lot of the hype in AI is kind of blown out of proportion, in my opinion. You have to be very careful. So let's bring all this together. What do we do right now? Like I've always said, the stock market is not efficient. The stock market goes out of control to the upside and it goes out of control to the downside. And us as investors, all we have to do is just simply sit and we wait and we capitalize when things make sense. Like, take a look at this 5-year chart right here on the NASDAQ. You could see that in 2021, the NASDAQ fell roughly 35% from peak to trough. Maybe the market was a little bit expensive up here, but it was definitely cheap down here. So you want to be a little bit more cautious up here and a little bit more, hey, I'll take on some risk down here. But as the market ran up so much, like, let me clear up this chart a little bit here. As the market ran up so much in the last couple years, maybe things did get a little bit stretched. Maybe we just went a little bit farther than what we actually should have went. Maybe we just kind of overstayed our welcome on this higher valuation level. Like, look at this. For just a couple years, from 2023 until 2025, 130% for the NASDAQ. Like, that is not sustainable. That is not justified. Like, the number one thing that moves the price of a stock in the long term is what the earnings per share does. The earnings per share of the NASDAQ did not go up 129%. Those companies all held within a NASDAQ that are automatically scaled to the percent that they're in the index. They did not go up 129%. So again, it's pointing to the market is a little bit expensive. And if we scroll up here a little bit, you could see that the valuation level of the S&P 500, because the S&P and the NASDAQ do move together, so I am going to reference these back and forth. The forward 12-month PE ratio for the S&P 500 is 22.4. The average 5-year PE ratio is 20, and the average 10-year PE ratio is 18.7. So from 22 to 18.7, that could be a significant dip on the S&P 500 because, again, These two lines are going to overlap again. This is going to overlap again. The market is going to correct down, or earnings per share will go up, or a combination of both. Let's flip over to this other chart right here. I know we've talked about it before, but it did just update, and I do want to talk about it really quick. This shows you again what the S&P 500 is doing in relation to what the PE ratio actually is. So you could see that in 1999, the PE ratio was somewhere around 25, but right now the PE ratio is somewhere around 24. So we are by no means in a cheap market. We are in an expensive market. And I know that like AI is great and AI is amazing and Tesla's going to have Optimus robots and self-driving cars and we're going to have all these AI agents from Nvidia and we're going to have all these chips from TSM. But at the end of the day, price is what you pay and value is what you get. So if you overpay for a good company, like yes, you own a good company, but you simply paid too much. Like good investment and good company is not the same thing. You have to get a good company at a good price. So again, a lot of good companies up here in 1999. Amazon was one of them, but Amazon fell 97% on this dip right here. Who's to say that companies like Palantir that are valued pretty similar to what Amazon was valued up here, who's to say that Palantir is not going to fall that much too? I'm not saying it's going to happen, but I am saying that Palantir is valued pretty lofty right now. Again, good company, but not a good investment and not a good valuation level. So what do we do in our portfolios right now? Like I'm sure a lot of you guys are stressing right now that we're on this dip and you're worried about getting a margin call and you're worried about just what do I do? Do I sell? Do I buy? Do I buy the dip? Are we still overvalued? Like what do I do right now? And I want to simplify this for you. And the first thing that I want to say is this. Do not let your emotions consume you right now. I realize that there's a lot of people on X, on YouTube, on Instagram, on TikTok that are fear mongering, that are telling you, hey, this is the beginning of the major stock market crash. But just a couple weeks ago, those people were buying like MicroStrategy stock and Palantir and SoFi and all these overvalued companies because the share price was simply going up. They were geniuses. But now that the market's going down and they're getting smoked and they're getting margin called, they're now putting on their risk management hats and saying, oh my God, I need to trim some risk. I need to sell things as they're going down because I'm just over leveraged right now. But at the end of the day, they're doing the complete opposite of what they should do. Like what I was doing, and let's just flip back to the chart. Like what I was doing as this market got a little bit more expensive, I was de-risking my portfolio. I was not de-risking as the market's falling. I was de-risking as the market was getting more expensive fundamentally. That is what you want to do. So when the market's falling and everyone's like running around with their heads cut off, I am kind of just like laughing in the back of my head, like, yes, I feel bad these people are losing money. But at the end of the day, human nature doesn't change. When the stock market's going up, everyone's a genius. When the market's going down, everybody just panics. When people panic, that is when I like to swoop in and that is when I like to capitalize on this stuff. So nobody knows how low the market's going to go. Nobody knows how far we're going to fall. In my opinion, I wouldn't be surprised if we go down another 15 or 20%. Again, I've been talking about this on YouTube for a while now that the market is overvalued. But there is a caveat to that. And it's not just like, okay, we're going to wait for a 15, 20% drop and then put all our money into it and go YOLO calls. It's not that easy because nobody knows exactly where the bottom of the market's going to be. Nobody knows exactly where the top is going to be. Like who's to say that right now this isn't just a normal little healthy correction that the S&P and the Nasdaq are doing and then we have the next leg going higher. Like it is very possible that that's going to happen. And hey, in the long term, like all the companies within this NASDAQ index, they're going to continue to grow their earnings per share year after year after year, which is then in turn going to push the prices of these stocks to go higher. But in the short term, I think we're going to get a lot of volatility. And if you just look at what happened right here, like the Liberation Day tariff dip that we had earlier this year, the NASDAQ went down 22%. And again, we're only down like 7% right now, so we could have some more room to go. But this right here panned out to be a really good buying opportunity. So yes, I am starting to dollar cost average into a couple names. I started buying Meta. I started buying TSM. I started buying Amazon. There are some companies that I feel like are trading below intrinsic value right now that I feel like are some deals if you want to swipe in. Of course, there's other companies that I cover in my Discord, but those are my favorite companies right now that I'm just talking about right here in this video. But also understand like Meta, for example, like just because I started to buy it somewhere around this category right here, let me go to a 1-year chart. We could see a little bit better. Like just because I started to buy it right here, like yes, I'm down a little bit on some of the stuff that I bought, but I did not go all in right here. I'm starting to dollar cost average in, I'm starting to sell some puts, I'm starting to buy some calls, which all my durations are pretty much, like 1 or 2 years out from right now. So I have a lot of time in these plays, but I am optimistic that with time, these companies will return back to all-time highs because we're getting in at a good valuation level right now. But also, if the market keeps falling, if the S&P falls, if the Nasdaq keeps falling, all these companies like Meta, TSM, Adobe, Tesla, AMD, CoreWeave, Nvidia, Apple, Microsoft, Marvell, These companies, they're going to go down with the index because everything just goes with the tide. If the tide goes out and down, those companies are going to go out and down with it. So I'm very mindful that yes, these companies might be compelling right now, but also I have to understand what the macro thesis is. I have to understand that overall the market is a little bit expensive. So when that corrects, those companies will go down with it. And these companies also have a higher beta, which means that they're going to fall more. So if the S&P goes down 10%, we're going to see companies like Tesla probably going down 20%. But again, that is just creating buying opportunities for us. We are here to capitalize when things are on sale. We buy calls, we sell puts, we buy shares. So my plan is this. As Meta keeps falling, as TSM keeps falling, as Amazon keeps falling, I am going to keep adding risk on the way down. I'm probably not going to time the bottom perfectly, and nobody really is going to be able to do that. And some of my shares, yes, I'll get pretty close to the bottom, but 1, 2, 3 years down the road from right now, you're probably going to wish that you were buying Amazon at these price levels. You're going to wish that you're buying Meta at these price levels because, yes, there's fear in the market. Yes, there's a lot to worry about. But these companies are highly profitable. These companies have a moat. These companies have a durable competitive advantage. They're going to be okay in the long term. But in the short term, there's going to be a lot of volatility. So please do not get sucked into your emotions. Do not try to justify selling all your stocks right now because they're down. Why did you not look at yourself in the mirror a couple weeks ago when stocks were at all-time highs and say, hey, the market's getting a little bit stretched from fundamentals. Why don't I put a little bit of money on the sidelines and take some profits? Like I have right now, 20% of my portfolio in bonds. You might think that's dumb. I don't think it's dumb because the overall market valuation is hot. So everything's probably going to go down with that when and if we get a deeper correction than what we have right now. But if we don't get a big bad correction, guess what? I'm going to sit at my bonds, collect my yield, and all my other stocks and all my other option plays are going to make money on the upside. So I am positioned to win either way. It doesn't matter if the market goes up or down. I'm going to win. And I don't care what YouTube video you watch. I don't care what person you listen to out there. I'm telling you this right now. The market is expensive, and not a single person on planet Earth, nobody knows exactly where the top or the bottom is going to be at any given time. But the name of the game is this. You want to capture gross movements. And what I mean by that is when something is largely undervalued, allocate to it. When something is largely overvalued, start to trim a little bit from there. So again, like the market as it's been going up, I have been starting to trim a little bit and start adding to bonds because I captured the gross movement right here. The market ran up a lot. Now we're getting a little blow off top, correcting a little bit lower. That is healthy. That is needed. We need this stuff to happen because if the market kept running up at the rate that it was doing, like we were looking straight into a 1999 dot-com crash scenario. But this dip right here, this blow off top, this is healthy. This is needed. And it's a good reset to wipe out everybody that's on margin that has their ratios like completely out of check. All right. So with that being said, I'm ready to win if the market goes up. I'm ready to win if the market goes down. It simply doesn't matter. I have my portfolio allocated in a way that if we go down, I'm going to capitalize. And if we go up, I'm going to capitalize too. I'll buy things when they're cheap. I'll sell things when they're expensive. And the emotional herd that's running around with their head cut off like they're a bunch of chickens, I am simply capitalizing on them. They are buying puts right now because they're scared. I'm going to sell them puts for top dollar because they are scared. They are not buying calls right now because they're scared. I'm going to buy calls right now because they are scared. I'm capitalizing on the emotional aspect of humans and arbitraging that to get the best prices for options. I'm going to buy call options for the lowest price, and I'm going to sell put options for the highest price. That is the name of the game. All right. Hope you got value from this video. Keep your emotions in check. Understand what you own and why you own it. Always have a plan if the market's going to go up or down to capitalize. And with that being said, I'll see you guys in the next video.